Ladies and gentlemen, the curve has inverted again. Now, you may have heard of this in the business press and financial media over the last few years, that when a curve inverts, it's not necessarily good news. In fact, it's bad news, and usually they're referring to the US Treasury bond market. If that curve inverts, it augurs a recession. But that's not what we're going to be talking about. And importantly, one of the key points I want to make during this whole presentation is that you don't hear about this other curve that we're going to talk about in your financial press, in your business media. Probably the only time you've ever heard anyone discussing this curve being inverted is on this show, which I presume is why you're listening to the show. Jeff Snider, I was just going to say, Jeff, welcome to the show, but I have to introduce you. Jeff Snider, the head of global research for Alhambra Partners. Jeff, we're going to talk about which curve?
We're going to talk about the Eurodollar Futures curve, which is amongst my favorite. And the reason it's amongst my favorite is because it has so much information, so much of a really good track record in telling you a lot about what's really going on inside the monetary system, inside the real economy, in real time. It's data that we have, it's an indication that we have that really gives you some keen insight into places that you can't otherwise normally, directly observe, which is really what we're trying to do here.
So in March of 2019 and August of 2019, the US Treasury curve inverted, and we heard about it. And we heard that it probably didn't matter this time because X, Y, and Z were different, and therefore likely we're not going to have a recession because globally synchronized growth and it's booming and everything like that. We never heard about what happened in June of 2018, but before we go to June 2018, Jeff, it's Eurodollar University. So we always talk about the Eurodollar, but let's introduce it because there's the uppercase Eurodollar market, and then there's the lowercase Eurodollar, which we refer to as the shadow money, the unknown, the private banking system creating money out of thin air. But Eurodollar Futures, just introduce it for us. What does it represent? And then take us to June 2018.
Well, these are derivative contracts that give you the entitlement to a $1 million Eurodollar deposit at whatever time, whatever contract maturity date you specify. And really, it's a bet on 3-month LIBOR because the price of the Eurodollar futures contract is indexed to 3-month LIBOR at that future date. So really, you're betting on this offshore US dollar money rate sometime in the future. So the market tells us about what the vast majority of banks and financial participants and all these sophisticated and large-scale investors are what they're thinking about, and specifically in terms of 3-month LIBOR and all of the factors that go into determining what 3-month LIBOR will be at various points across the future. That's why this is such a dynamic marketplace, but also an important and very good indication of what's really going on, what people are really thinking about in terms of the system itself. And you're right, there's a distinction here. The Eurodollar futures are specifically related to LIBOR and Eurodollar deposits, fictional Eurodollar deposits, because these are cash settled contracts. And so it's a subset of the wider, smaller E or smaller case E Eurodollar system that we talk about. So, as important as this Eurodollar futures curve and the contracts are, it's still only one piece of the puzzle. It's a very good key piece of the puzzle, but it's only one piece, and we need to look elsewhere for confirmation. So if we see something happening in Eurodollar futures, we think, okay, that's got our attention. Now let's see if we can see other things going on in other places that give us a consistent, coherent picture of the entire small E Eurodollar system and what's really going on there. So we can start with Eurodollar futures and that curve, and then look elsewhere to get a sense of, is this really happening? Is this really going on? Is this something we should be concerned about, or is it just, a quirk or a technicality?
And so when we say inversion, what we're saying, for the audience that may not know, is that future rates, the expected path of future rates, will be lower than the near-term contracts. And the near-term contracts are going to be wherever they are because they're a money-like equivalent, a competitor to what the Federal Reserve is doing. So the Federal Reserve has some control, reasonable control, over short-term interest rates. And if the Federal Reserve is setting the reverse repo rate or the federal funds rate or God knows what they're setting these days, at a certain level, you would think Eurodollar futures should be around that area. But then when they invert, that longer term outlook is saying, aha, we expect that short-term interest rates will be lower at point X because probably the Fed is going to be lowering rates. Why would the Fed be lowering rates?
That's the key. That's it right there. Again, it's all of the factors that go into why would rates be where they are at some point in the future. And it starts with the idea of monetary policy. And you're right, the Federal Reserve has all sorts of monetary alternatives like the reverse repo and IOER that it uses to influence money rates around the world. But remember, this is the future. It's not what the Federal Reserve is doing today. It's what the Federal Reserve might be doing a year from now or 2 years from now. And what Jay Powell thinks he's going to be doing a year from now or 2 years from now may not end up what ends up happening in the real world, in the real marketplace. And usually the Eurodollar futures market has been ahead of the curve, ahead of Jay Powell and those like him. You can go all the way back to 2006 when Eurodollar futures inverted, saying to Ben Bernanke, hey, you've got some serious trouble brewing, while he was talking about subprime being contained. So the Eurodollar futures isn't strictly about monetary policy. It's about all of the economic, financial, and money factors that combine that are going to determine what the Fed is going to do in the future, even if the Fed doesn't know it's going to do it today. Because usually the Fed and economists and their models are way, way behind the times and are often very blind to all of these developments, as they were in 2018. Going back to June of 2018, remember, it was ridiculous, preposterous to think that the Fed would be cutting rates at that time, because back then everybody was convinced, as now, inflation, it's coming. The Fed's going to be not just hiking rates, it's going to be hiking rates according to an accelerated schedule. That's what everybody believed, the hawkishness of the middle of 2018. And here comes this Eurodollar futures inversion in June 13th of the middle of 2018, in the midst of all this inflation hysteria. The curve's got a little bit of an inversion kink around the 2020, 2021 contracts, which were just outside the 2-year window.
Dead on right.
Which said, basically, wait a minute here. You guys are all talking about rate hikes and inflation. We're seeing some bad stuff develop that we're now going to hedge as lower interest rates, lower 3-month LIBOR rates in the future. Now, the initial inversion wasn't much, just a couple of basis points. But when you see something like that happen, especially during a time period like that, it should not have been there. If anything, the curve should have been steepening, with the market saying, yes, Jay Powell's going to continue to hike rates to the foreseeable future. The fact that the curve first flattened before June of 2018 was already a warning. And then when it inverted, what that said was, this is serious stuff. Things are going wrong in the monetary system, in the real economy, at such a pace and in such a way that we expect the Fed to have to turn around. There is a growing chance the Fed is going to have to cut rates in the future rather than raise them. And of course, again, June of 2018, everybody, the idea that this was going to happen was laughable, because nobody was thinking that way. And yet here you had this huge, robust, liquid, sophisticated marketplace saying, there's something really wrong here.
And to your earlier point about multiple independent points of view confirming, it wasn't as if the Eurodollar futures curve just had a palpitation and a fit. There were things happening. In February of 2018, we had Jerome Powell join, the hawk, right? But guess what? They completely ignored that, because they were looking at the liquidations of stock markets in the United States and China in January. The dollar started rising in April. We had emerging market currencies starting to plunge. We had, I believe, Argentina losing the grip on their recovery. May 29th, a buying panic in US Treasuries and German bonds. So it wasn't in isolation. We had a problem, and it proved right. By the end of the year and by the end of the day, the Jerome Powell and the Hawks had turned to doves.
Right. I mean, Emil, that's how these things go, right? It's a series of escalating warnings that get worse and worse and worse until some point you say, okay, something's going to really break here. And that was what the Eurodollar futures inversion was in June of 2018. That was the point where, as you just went through a litany of warnings, that these escalating warnings throughout the early part of 2018 were saying things are going wrong, things are going wrong. And then when that curve inverted, it was the market saying, okay, this might have been the point of no return. We've passed some threshold where these warnings are no longer warnings. They're just bad things that are happening, and they're getting worse. And of course, the way that 2018 ended into 2019 was, yeah, things got a lot worse pretty quickly. And so, the Eurodollar futures, back to our original point, it's one of those things that when you see something like a cork in the curve like that, you really need to pay attention to it, because it's one of those primary, very deep-seated developments. And it's the people inside the marketplace telling you what's going on in places you can't otherwise see. You really got to pay attention to it.
All those things I listed were monetary shadows. That's where they were going wrong, in the monetary shadows. And I hope, audience, that's why you're listening and watching this show. They weren't going wrong in the media narrative. Everything was going great there. Jeff, speaking of the media, in December 2020, I remember just a litany, as the word you used a second ago, an avalanche of news stories that the Eurodollar curve inverted again, and that maybe people should take a moment to consider what this deep, maybe the deepest market in the world. I've often heard that this is the deepest market in the world, the biggest one. So, Jeff, do you remember that was just on Bloomberg and CNBC constantly, the Eurodollar inversion in December 2020?
Yeah, except the inversion was inverted. It was an inverted inversion. It was the quirk was this time, the curve was, the December 2020 contract was a bit higher priced than lower priced, than the 2021 contracts up to March. March is the most liquid. The quarters are the most liquid. So what that said was that the market was sort of hedging and preparing for a LIBOR spike, a jump in LIBOR prices, a short run kind of a thing, sort of a year-end bottleneck or quirk that required some serious hedging component to it for reasons most people couldn't explain. And the reason they couldn't explain was because Jay Powell supposedly flooded the world with digital dollars to the point that we have a problem of, at least in the mainstream narrative, too much money floating around. But yet, if we have too much money flowing around, why was the Eurodollar futures curve inverted, which was, why was this little quirk or kink in the curve showing up in December of 2020? That was the market saying, there might be trillions in bank reserves, but we don't trust them when the going gets tough at the end of the year. We might have to prepare for an unknowable LIBOR spike or some kind of illiquidity related to the year-end bottleneck.
Ladies and gentlemen, I was offering Jeff a piñata to swing at violently. I hope you understood when I was saying the media, that it was in the news. It wasn't in the news. None of that was in the news. But Jeff chose to instead educate you instead of beating a dead horse, even if it was a piñata. Jeff, I'm going to bring up a graph that shows something similar for December 2021. How many inversions are we looking at now? Inversion? Inverted inversions. I don't know what we want to call it. Let's call it a kink in the curve, right? And it's, now that December year-end sort of fear has repeated. And it's been there almost all year. In almost every curve so far this year, you see that little bit of a bump. It's just a couple basis points, and it's not a whole lot. It's not the market saying we're scared to death of what might happen at the year end, but it's enough that it gets your attention because, as I said before, it should not be there. And it definitely should not be there if you believe bank reserves are money, and the Federal Reserve has flooded the world with even more bank reserves and money this year than last year. And yet here's the curve saying, we got to hedge against a possible year-end problem for the second year running. It's the market telling you that the idea of bank reserves being effective money and therefore the world consistent with too much money just isn't true. Again, it's not the market saying that everything's going to crash by year end. That's not what we're talking about. What we're talking about is a technical point of illiquidity, calendar quirk that everybody knows about, and yet here we are with the curve distorting itself in such a way that it shows you that there's some very real concern about what could happen around this year-end bottleneck. When I opened the show, I was very dramatic, but you, in your article, which was posted on the 7th of July at Alhambra Partners, and the title of that is Eurodollar Curve Quirk Trivia but not trivial to anti-inflation. In your article, Jeff, you make that point. You say, at the current date, this thing is not the same class as the June inversion had been, that it's an oddity. It's a fly in the soup right now. And it is, yeah. But also, if we take a broader look at the Eurodollar curve, which you do in a nice graph that I'm going to pull up here, besides the technicality, I think it shows what we've been saying throughout this year, is that this reflation, I hope it gets going soon. That's what I want to say. And that's what the Eurodollar team is also looking at and saying, when are we going to have the reflation start again? Look at this, Jeff. What am I showing here?
Those are the Eurodollar futures curves at various points over the history of the 21st century. And you can see how lower and lower and lower and flatter and flatter and flatter it got, so that we get to 2021 and we look at that curve and we're saying, this is the curve that everybody was saying was supposed to be hugely inflationary, that inflation is coming, the Fed's going to be pushed off of its zero interest rate policy. No, not even close. As you pointed out, Emil, it barely qualifies as reflation. I struggle to classify what happened this year at all as reflation, and this is one key reason why. And I think a key reason why these curves, including the Treasury yield curve, have been so low and flat and stuck in such a position, is that quirk in the curve. That what that says is, yes, okay, this is not like June of 2018 where that inversion meant something big had taken place or something big had changed. But that quirk in the curve this year and last year is essentially skepticism or distrust about the monetary situation in the global system. And that kind of a distrust says, you're not going to get inflation. Chances are something's going to go wrong and we're going to go back into a dollar shortage situation long before we ever get there. And that's really what the message of the curve is this year, and where the prices have changed over the last couple of months, as well as growing distrust that we're going to make it into reflation because something is going to go wrong regardless of the trillions of bank reserves. Those things don't matter. Something's going to go wrong in the system to trip everything up again before it really gets going. And that's really our point here with looking at the curve is, yeah, this isn't a big deal, but it is. It's a big deal in the sense that the market does not trust that Jay Powell's got his finger on the pulse of what's really going on in the system, and that something could really go wrong, no matter how many trillions of bank reserves there are, before we ever really step into even reflation. Let alone, forget inflation. We still need to get into reflation first.
You end your article with this image from David Parkins, and that was from our second episode, Jeff, ages ago, decades ago. Noah, the greatest liquidity event since Noah. Jay Powell on the ark, looking to the heavens.
And don't forget, he went on 60 Minutes in May of 2020 and said, yes, I flooded the world with digital dollar. He said that. He lied through his teeth and said that. So he was obviously trying to get people to believe that narrative, the idea that the Fed has printed money, not just money, but a flood of it. And that's just, the market is saying, well, there's a flood of bank reserves, but those aren't the same thing.
Is there anything that we need to tell the audience before we move on to our next article, Jeff? Anything that we didn't cover in here?
No, I think it really, our major point is, look, this is not right now, it's not it's one of those oddities that gets your attention and starts to ask, get you to ask the right questions about, are we really in a situation where there's too much money around the world? Because the curve is starting to say, no, there's more risk of the opposite, which is where you then start to look at other places and say, yeah, there's a lot of agreement out there in the marketplace, not in the media, but in the marketplace, that inflation has got zero chance here. The market is more positioned to things going wrong than going right.
In part 2 of this episode, we're going to look at the world's 4th largest economy, the economic engine of Europe, Germany, and see what's happening there, and because it's such a big export power, what that's telling us about the rest of the world. But we're going to do so by starting out in Japan first.